Hello, this is Susan Hayes, the Positive Economist, and today I'm going to go through another of the series of videos of investinginyouth.com introducing Wall Street to the classroom. I am often asked the question, how can I gain exposure to the stock market if I don't want to manage it myself and if I'm not comfortable going down the line of direct stock equities? Well, today I'm going to answer that question in this video, but I'm also going to do it in such a way that would be student-friendly activity to bring to your classroom. Let's take 3 case studies. Ava is an independent woman who wants to take care of her own finances. She's a busy qualified solicitor and she doesn't know much about the stock market. She doesn't have or want to put a lot of time into it. She's quite up to date on what's going on in the world, so she is confident that she would know some reasonably good sectors and economies to invest her money in. She wants to keep her costs as low as possible and has a lump sum of €10,000 to invest. Now, Scott is financially comfortable. He is a civil servant but also has a small home business. He understands risk and is willing to spend time nurturing his investments. He enjoys the stock market, reads about it regularly and has done 2 courses in it. He has a time-tested, easy-to-follow strategy. He doesn't want to pay any management fees and has €1,000 per quarter to invest. And the last one, Kira, who's a teacher and loves property. Although she understands and is successful renting and selling houses, she wants to diversify into the stock market in a small way. She doesn't want to spend any time at it and knows little about it. She doesn't mind paying fees just as long as she gets some decent exposure to the market. She wants the choice to be narrowed down so that it's easy as opposed to most profitable. Much of her disposable income is tied up in mortgages, but she has €200 per month to invest. So what line should each of these people approach the stock market with? Well, let's look at the attributes of each type of exposure. Let's take direct stocks. If I decide to buy individual companies myself, there is absolutely no management fee, as I am managing my portfolio myself. I'm not paying anybody else to do it. In terms of transaction costs, every time I buy and every time I sell, I have to pay for it. The diversification responsibility is completely up to myself. I can either have 1 stock or I can have 40 stocks, but the diversification option is completely up to me. There are a huge choice of companies to buy in the stock market. If I'm going to go down the line of the direct stocks, I probably am better off with the strategy, as very few people can simply pick and choose what stocks they want and put it into a proper money-making activity. The time frame again is completely up to me. I can buy a stock and sell it within seconds, or I can buy a stock and sell it ever again. And also, I do need a broker to conduct this transaction. If I want to buy, I have to have a stockbroker that I can buy through. Now, if I don't want to choose this option and instead want to go down the line of unit-linked funds, this is where I would go to somewhere like Eagle Star or Standard Life, and they would present me with a product that I can invest in. Now, bear in mind, there are big costs to these, as there is layers of administration wrapped up in them. There is the person that I have to pay who actually comes to me and sells me the product. The fund manager has to be paid. The company that is selling me the product has to be paid. So there are a big range of costs involved. Now, the diversification is already looked after, as the fund that they would present to me would already have diversification within it. There is a various selection through brokers. They might have 10 funds on offer that might suit me. The time frame, there is usually a minimum and a maximum involved. For example, I might have to leave my funds there for 5 years, and if I want to take them out before that, I would have to pay early encashment fees. And alternatively, the fund may only have a certain lifespan. I can't invest in it infinitely. There is a certain amount of admin involved and form filling, and in addition, I would have to go through a life company or an investment company for this. Now, finally, there are exchange-traded funds, which may be a happy medium. This is where I would have a fund which would be a collective investment vehicle like in the unit-linked funds, but I don't have to go through a life insurance company in order to actually buy these. I can buy them through the stock market. So there would be a small management fee going to the fund manager in this case, and the transaction costs would simply be the cost involved in buying it and selling the product. The diversification is already looked after, as there is already diversification within these products. There is a wide choice to choose from. As I'm speaking, there is about 1,600 exchange-traded funds on offer in the stock market. I do have to make a decision myself. There is nobody there to advise me on the type of ETF that I can avail of. The time frame is simply, again, completely up to myself. I can buy an ETF and sell it within a second, or also I can buy an ETF and hold it for an infinite length of time. In this case, I can buy like a stock through a broker. I don't have to go through an insurance or a unit-linked company in order to do so. So if you were to take 15 minutes to think about which type of a product would suit each type of person in the case study, this is what I would recommend you do in your classroom. And put it to your students that for this type of service, people do get paid. These are called financial advisors. So let's say they're being paid €150 for the appointment, so make sure that they give their clientele a good service. So if we skip past this, and I would ask the question, well, what would you recommend and why? Now, if I was the person being paid in this particular scenario, I would have the following recommendations. In Ava's case, I would recommend that she goes down the line of ETFs. She wants to minimise her costs, so I would say that maybe the small management fee in the ETFs would be preferable to the large fees involved in the unit-linked funds. Now, in terms of transaction costs, since she has €10,000 to invest, the number of transaction costs should be relatively small, and therefore the total amount she would have to pay in fees should be relatively small compared to this €10,000. Now, she is happy to decide on sectors and companies, but not individual companies. Now, this is where I really think ETF should suit her, because this is ideal for her type of case. And in the case of the decision-making process, she's happy to make her own decisions. Now, Scott, on the other hand, doesn't want to pay any management fees at all, so I think he should maybe look at direct stocks. By choosing a low-cost broker, he can keep his transactions very low, and if he's happy to take on the role, he can create his own diversification. Now, what really stands out to me is that he has a time-tested, easy-to-follow strategy, so he knows what to buy and when to sell, and this really is the defining characteristic of somebody who should choose the line of the direct stocks. And also, he can regularly invest €1,000 per quarter into a different stock to build a portfolio. And finally, we've got Kira. Now, Kira doesn't mind costs as long as she doesn't have to put time and effort into it, so she was happy to pay for somebody else to take on the responsibility, which may be suitable for unit-linked funds. In addition, she wants to keep her selection narrow, and if you want to do this, going down the line of where a company can offer you 5 or 6 or 10 funds to choose from would probably be best. Now, if she has a small investment of €200 per month, it's ideal for a fund like this as opposed to a listed product. Because remember, every time you buy a stock on the stock market, which would include ETFs, you would have to pay a transaction fee. Now, if she was to pay a transaction fee every time she invested €200, well then this would make for not a very commercial decision at all. However, with the unit-linked fund, you can choose to put in smaller amounts every month and you won't be penalised for this. So already, using the knowledge that you have gained from this series of videos, you have enough knowledge to make the decisions most people don't even know that they have the choice about. You are already racing ahead of the masses. And this is Susan Hayes, the Positive Economist.